Let's take a look at the stock of Supermicrocomputer post-earnings report. I'll definitely discuss the financial results that Supermicrocomputer has shown. Also, we'll definitely look at the volatility, what's happening there. We'll examine the volatility smile and I'll show you the volume of options trading. We'll consider crucial levels and why the price couldn't break $700. I'll specifically show you why. Supermicrocomputer stocks have reported earnings. Let's take a look at the report. Net sales reached $3.85 billion, showing significant growth compared to $3.66 billion in the second quarter of fiscal year 2024 and $1.28 billion in the same quarter of the previous year. Gross margin was 15.5%, slightly up from 15.4% in the second quarter of fiscal year 2024. Net income amounted to $402 million, a notable increase from $296 million in the second quarter of fiscal year 2024. Diluted net income per common share was $6.56, showing growth from $5.10 in the second quarter of fiscal year 2024. Cash flow used in operations for the third quarter of fiscal year 2024 was $520 million, with capital expenditures of $93 million. Well, if we have such positive results, such significant growth across all indicators, the question is, why are we seeing a drop in this stock? Supermicrocomputer stocks are down almost 40% from their historical highs. What's the matter here? I'm saying that technical trading is at play here. Market makers start selling on accumulated hedge. But let's look at the volatility. What's happening here? As we can see, the volatility has risen significantly. It was related to pre-reporting, but then it dropped and now remains at 70%. This is still very high volatility, especially for companies in the S&P 500 index. Let's look at the volatility. And as we can see, the closer to the strike, the higher the volatility, both in the upward and downward directions. But I want to say that for more distant strikes, if we consider towards the upside, volatility does not increase, but towards the downside, volatility does increase. This situation is normal because investors hedge their assets by buying put options. Now let's look at the historical and implied volatility at this moment. Historical volatility is the gray line, implied volatility is the white line. I remind you that you can trade not only with the stocks themselves, but also with volatility for this. You need to use derivatives. I'm talking about how volatility always returns to its historical values, meaning if you know where volatility is likely to revert, it's much easier to trade. But again, here the situation is slightly different. Here, most likely historical volatility will gradually decrease over time because, without a doubt, once we're included in the S&P 500 indices, maintaining such high volatility for this stock will be challenging. So I wouldn't count on volatility increasing here. Now, let's look at the most important indicator. It's the options trading volume. As we can see, the highest volume is concentrated at the $800 level. This is regarding the call options. As for the put options, the highest volume is concentrated at the $700 level. And what we can observe, it seems, is why the stock bounced off this $700 value. It's primarily due to this massive volume. It's a huge support wall that's very difficult to penetrate. As we can see, we've touched these levels twice already, even 3 times in February, April, and now in May, 3 times we've touched this level. And still we can't break through because this massive wall of options just stops any movement of this stock. But I immediately say don't lose hope, because even these significant levels, these massive walls, also have a tendency to break. I'm saying that sooner or later, I assume that the price won't withstand the pressure downwards, because the more touches of this level, the higher the probability of further price declines. But how does this situation work? I remind you that market makers sell options. For example, let's focus on put options right now. When investors and traders are buying options en masse, the market maker is obliged to hedge, obliged to sell those options en masse. So when they sell those options en masse, they open a long position on that stock. Therefore, they must sell stocks, effectively entering a short position. And therefore, as long as options and they have to open these positions according to the delta, that is, if the delta is, for example, 4, then they must sell 40 shares per one option. This is delta neutral hedging. And gradually, when options expire, that is, become worthless. That is, the market maker is obliged to buy back the stocks that they sold. Therefore, this can also increase the price of that stock. What I mean is, if this $700 wall were to be broken now, then the market maker would have needed to sharply increase their hedge. That is, they would have needed to sharply sell stocks, hedge their sold options, and they would have needed to sell stocks to close the hedge on the calls. And the more stocks the market maker needs to sell, and at that moment, or it could have dropped to the next level of $650 or $600. Now let's take a look at the 3D volatility, which concentrates all the volatility related to all the spikes. All the option expirations, it helps me build sound strategies. Also, let's see what can happen with these stocks. I remind you in every video I say that my philosophy is that it's impossible to predict price movement. I don't know where the stock will go. I don't know how to predict stock movements. I tell you that the main thing is how to make money. It's through sound position management. That is, you need to build a portfolio in such a way that no matter where the stock goes, you make money from it. And the secret is also that if you build your portfolio and your investments based on probability theory and mathematics, you will also make money. Let me tell you more about what I'm talking about. Look at the strategy I've built through options. If the stock price rises, for example, to $1,000, we will get $20,000. If the stock price falls to $600, we will also get $20,000. And as we can see, there is no loss here. The efficiency profile is all positive. The strategy looks like this through options. options. So again, I'm not just telling you you trade like this and make money regardless of price movement. I'm just showing you how it can be done, but I immediately warn you. This strategy is very complex. It's based on selling uncovered options. You can lose all your money. It needs to be managed. All option strategies need to be managed. You need to know when to close, when to open additional strategies, sell stocks, buy stocks. It's a complex strategy. And just like that, if you open it, you can lose all your money. I'm warning you right away. This is purely to show how you can make money. What I'm saying, you can make money, both on upward and downward movements. But the most important thing is logic. I always try to explain this to you. Let's also look at what the market predicts. We can see that the market predicts for May 31st that the price will be around $700 to $720. So here is the highest probability. This indicates that the market is implying that the price is likely to fall. Again, it's very important to pay attention to this. Now let's look, for example, at August. And as we can see, the market says that closer to August, the price will be around $650. I can show you this in more detail. If we look, for example, at November, the market is implying a decrease to $600. Here is the highest probability. So the drop over 6 months can be another 20%. But I'm telling you, this may happen not over 6 months, but literally in a couple of months. This also absolutely aligns with my philosophy. I always tell you, my friends, don't go against the market. If the market is showing you a specific price, why argue with the market? I just don't understand this. If you move along with the market, you'll start making money. That's the most important thing, because the market is always right. Yes, if you go against the market, you might make money a few times, but mostly you'll lose money because thousands of people have lost money. Just listen to me, please. Learn from the experiences of others and immediately start analyzing and managing positions wisely. That's my philosophy again. But I'm by no means advocating selling this stock uncovered, because that's very dangerous. I'm just showing what could happen here. Also, I advise you to watch my previous video where I talked about the principles on which my new portfolio will be built. Yes, very soon I will launch a new portfolio completely from scratch, where I will show which stocks to buy, how I form the portfolio, what's behind it, what strategies I use. I'll prepare thoroughly for this. And everything will be as open and transparent as possible. That's why I'm using the voice of the neural network to show you the score and display the account balance, because it will be safer for me. I will also definitely show the Excel for the target I'm preparing. Everything here will be fully disclosed. I'll reveal in detail which stocks I'm buying, what I'm buying, and what positions I'm opening. This Excel will be absolutely freely accessible. Anyone can come in, look at what stocks I've closed, and why I did it at any time. So I guarantee you, everything will be of the highest quality. We will surpass all indices. It's already proven, but it's on a long-term perspective. I won't be able to outperform the index within a week. No, it will be a smooth outperformance over the course of half a year. You'll see the results. It's about to start soon. Subscribe so you don't miss the start of this legendary experiment. Also, ask questions in the comments. I'll answer your questions. Good luck to everyone.